Okay. Let us start. We'll discuss here the issue of corporate rules and practices that are conducive to long-term value creation. And it seems like a fitting topic for this bicentennial. So the Harvard Law School has been around for 200 years now, and it seems that it has succeeded in this test of long-term value creation. And the question is, when we turn our attention from law schools to business organizations, economic organizations, what is necessary to enable them, what is conducive to enabling them to be successful in the long term? And this is a big debate that has been going on for several decades now, taking different forms. And many of the debates in the corporate law fields in the end come down to this question of whether corporate rules and practices are good or bad for long-termism, whether they excessively push managers to focus on the short term or not. And we'll discuss this today, both with your participation as well as with the participation of three distinguished panelists. So we have here three graduates of our law school. John Finley, a class of '81, to my right. He has been serving as the chief legal officer of Blackstone over the last several years. And prior to that, he has been for a significant period of time a prominent M&A lawyer working at Simpson Thatcher. So he has seen this issue wearing different hats. To his right, Jake Jacobs, a class of '67, has been on the Delaware Supreme Court for a long time. Prior to that, serving on the Delaware Chancery Court, has written some of the most significant opinions in the M&A and corporate governance area. To his right, David Millstone, class of 2005. David is co-CEO of Standard Industries and has been, through this company, an investor both in private enterprises, operating businesses, as well as in a significant number of public companies. So he has seen those issues, again, in different settings, both in the private setting and in the public setting, as well as in various control contest situations. So we'll start with the panelists and some introductory comments. And we start with Jake Jacobs, who has written about the short-termism problem. Anyone who is interested in seeing more of his views, there is an excellent article that he has written about patient capital. And Jake will start with some brief comments about the short-termism problem.
Right, and with the emphasis on brief, I had this long, these prepared remarks, and I sent them to Lucian yesterday, and he said no more than 12 minutes. So, I'm going to jump around, and if you wonder why some of my comments don't hang together, we'll come back to them. But as you might have guessed from Lucian's introduction, I'm very long on general information and very short on the specifics, about the capital markets. I'm going to leave that to my two colleagues. But what I can say, and Lucian stole a little of my thunder, is that this long-term versus short-term issue is nothing new. It's been around for a long time, and the only change is the context in which it now arises. So back in the 1980s, the context was hostile takeovers. That is, specifically whether and when a corporate board can prevent a non-consensual sale of the company that would offer current shareholders a premium above market for their shares The Delaware courts rule that the board, as long as they have a bona fide business plan or vision to create corporate wealth over the long term, have the power and the free of any risk of liability to take reasonable measures in good faith to prevent a change of control, even if that deprives the shareholders of an opportunity for an immediate gain. So now we fast forward to 2017, same issue. The only difference is the context, because we're not now talking about a hostile takeover or acquisition by somebody who wants to buy the entire company and replace the board. Rather, what we're facing today, what corporate America is facing today, is an initiative by an activist institutional minority shareholder, someone who owns 5% or over, sometimes a little less, with the purpose of generating an immediate return to the shareholders by exerting pressure on the board, usually by threatening a proxy contest, either to cause the entire company to be sold to somebody else, or more commonly to divest certain of the company's businesses and distribute the proceeds to the current shareholders, or in some other way change the business plan in order to create an immediate return to equity investors. So the issue today is not how to stop a hostile takeover, but how boards can defend against an activist rather than a hostile acquirer. But the fundamental issue is the same. And in this setting, the articulation of the issue, the debate, is expressed in terms of long-term versus short-term language, and it's sometimes couched in advocacy terms of whether activism is good or bad for corporate America. And there's been a lot of writing about that, and Professor Bebchuk is among those who have a stake in that debate. Anyway, in discussing the issue, I'm going to make only 3 points. I'm not going to try to defend them now because it would take too much time. We'll do it later. But there are 3 points. The first is the long versus short-term characterization is too imprecise. It's closer to a metaphor or a slogan than a useful tool for analyzing this problem. We need to define the problem in a way that better helps us identify what's really at stake and how to approach it realistically. So that's point one. Point two is my argument is that although it's wonderful to be able to achieve a quick return on investment, and we all love that, boards should be empowered to assure all of the investors that the immediate returns, if there is one, don't come at the expense of the longer-term equity holders. And third, I will suggest some ways to accomplish this realistically in today's confrontational and divisive institutional investor and political environment. In order to do that, Lucian has asked me really to jump to the end, basically to toss out for comment my own suggestions, which are going to be not that many. There have been there's been a lot of writing and a lot of suggestions for needed reform, many at the federal level. Back in 2010, one of my former colleagues, then Vice Chancellor Leo Strine, who's now Delaware's Chief Justice, wrote an article suggesting at least 9 federal-level tax and securities law reforms that would amend the 1940 Act, that would enact completely new federal securities legislation, that would amend current SEC rules and adopt a bunch of new ones, and make other very high-level changes. The problem, as I saw it, was that these proposals, they would certainly solve the problem if they could be adopted. They would reform the current system that we have of economic incentives to manage portfolio companies and investment funds for the short term. But even back then, in 2010, the adoption of these kinds of top-down proposals was just politically improbable. It wasn't going to happen. And in today's toxic environment, I'm confident that those proposals would be dead on arrival. So to make, my point here is that whatever we're going to be talking about, unless, it's going to be purely academic, has got to be politically feasible. And that narrows the bandwidth, I think, of the, of the topics that is realism that we can talk about in terms of proposals for reform. So, granting that my co-panelists have a lot more wisdom on the subject of workable cures and fixes than I do, I'm just going to throw out a few thoughts, if only to kick off the discussion. One of them is that we ought to consider amending the state corporate statutes, and most notably Delaware's, as well as the SEC and stock exchange listing requirements, to abolish the mandate that corporations must have an election of directors every year. What could be done that would at least mitigate the problem of boards being under constant pressure to govern for the short term, or else face the threat of removal by a proxy contest, is to have an enabling statute that would allow allow the company to have a charter provision in which it opts into a regime of having director elections every 3 years or 4 years or maybe 5. The number, whatever the number is, it should be more than 1 or 2. And in that space, the directors would not be removable by the shareholders except for cause, which would be defined. Now, there are obviously problems with this. This would be a very workable proposal if we're talking about an IPO company, a company about to do an IPO. It's a lot harder if you're an ongoing firm and you're trying to get a shareholder vote to approve it. But there are ways around it, and one possible way around it would be for the firm to have a drop-down 100% owned subsidiary that would then do an IPO. Again, assuming that this enabling statute is passed, that would provide for a 3-year or a 5-year director term. So that's one area that we ought to be talking about. Another, and this is no great idea of mine, it's being done right now, although with great controversy, and that's dual class structures. We'll be talking a lot about that. But the dual, what we're talking about is a capital structure in which you have common stock that has 1 vote and then super voting stock, 10 votes per share, or you could have common stock with 1 vote per share and a different class of common stock with no vote at all. And that recently was done in the Snap IPO. It's generated a lot of controversy. But the point here, without getting into the technique, is make your company takeover proof, and then you don't have to worry about activist shareholders. But keep in mind that the purpose of these structural fixes is not simply to protect the boards from activist shareholders for the sake of protecting the board. Rather, the purpose is to further innovation, which is one of my big points that I'll come back to, by promoting the creation of patient capital. And so, as thus viewed, the issue can't be solved at the corporate level alone. We've got to do something to reform the capital markets as well in order to make this work. How best to do that? One possibility is that the SEC could amend its rules to allow the creation of an alternative securities exchange that would be devoted to listed companies with longer-term strategic value horizons. That is, it would be devoted to people who are willing to invest for the long term. And would be a specific securities exchange for capital, for patient capital. Under that model, the existing changes could function the way they are now. You don't need to reform them, but we would have this new animal. And it would work in tandem with a state law change that would allow boards to govern for 3 to 5 years. So, those are my thoughts. I look forward to the reactions of my co-panelists.
Thanks a lot, Jack. I understand the difficulty of speaking for a short time on solving the long-term problem. I'll, in having the other co-panelists respond, there were two questions to them, and each of them perhaps could speak about each of them separately. So the first question is, if we just look at standard public companies, most of the companies that we now have, and we put aside for the moment alternative structures that Jack mentioned, like dual-class structures of private equity. For public companies, what's your reaction to the strong concerns that Jack raised about short-termism by those companies? How would you like them to run in the future? Would you favor reforms of the kind that Jack mentioned or others? We start with you, John.
Okay. Thank you very much, Lucian, and a privilege to be here on this anniversary with such distinguished co-panelists. I looked at this issue really from two sides in my practice. At Simpson Thacher, in leading the M&A group, when M&A wasn't that busy, we sort of moved into corporate governance. And corporate governance we developed in working with companies and protecting companies, defending companies against activists. And when I left Simpson Thacher, I went to Blackstone, which, although often referred to as a private equity firm, does a lot of other things, private equity, real estate, credit, generally alternative investments, just stocks and bonds. And Blackstone is probably the ultimate patient capital. Our drawdown funds last 10 years. Our average investments are about 5 years. So it's at the opposite end of the spectrum of what I was dealing with in defending companies against activism. And I thought today I wanted to start with a quote relating to this topic, which is the following. Everyone who has worked with American management can testify that the need to satisfy the fund manager's quest for higher earnings next quarter, together with the fear of the activist, constantly pushes top management towards decisions they know to be costly, if not suicidal, mistakes. Now, the author of that was Peter Drucker, and that was 30 years ago. And the only substitute, and I changed the words a little bit, I took out activist. It was actually, he talked about pension fund manager. And instead of activist, he talked about raider. So to what was mentioned before by Jack, that this is an issue that has been around for a long time. And we know that this exists, short-termism. There was a football coach named George Allen. Anybody, that name sound familiar? George Allen, he was with the Washington Redskins. And he coached a team that was referred to as the over-the-hill gang. And what he did was he would trade draft choices to get older players who only had a couple of good years left, because his saying was, the future is now. And that was his explanation for why would you trade all your draft choices? Well, the future is now. I want to win now. And so we know in all our walks of life, regardless of what people say, which is that this is a false dichotomy or this choice doesn't really exist between short-termism and long-termism, we know it exists because we know it in our own life and in our own decisions between short-term and long-term. But we also have statistics that back this up. In terms of this issue. There was a McKinsey study done in 2013, and it surveyed, 1,000, 2,000 board members and C-suite individuals. And of that group, 63% said there is pressure to generate strong short-term results had increased over the past 5 years. 86% said longer time frame horizons would probably affect corporate performance, better financial returns, would increase innovation if they could work with longer horizons. So maybe they're all wrong, but that's what they feel that there is this pressure and there is this sacrifice that they're making. There have been even more recent studies. McKinsey did one in 2015. It was based on its corporate horizon index, and we could sort of debate whether it was a good index. We're not going to do that. But they have their index, which said clearly that true long-term minded firms outperform their peers on every measure. So there is data out there that supports that there is this short-term pressure and there is this sacrifice. Now, when you look at that exists even if we didn't have activism. That exists. Companies don't want to see their stock punished because they don't want to see their stock go down. The market, that is hedge fund managers who aren't even engaged in activism, just sell the stock out. And the hedge funds have incentives that are short-term oriented because, number one, their compensation is short-term. At the end of the year, depending on how much they've increased the value of the portfolio, they get paid. So at the end of the year, they're very, very focused. Did this portfolio increase this year? So that's one thing on the compensation. Second of all, if they're not doing well, they're subject to redemption. Sometimes there are lockup periods for a short period, but then those go away. And so unlike what I was talking about before with like Blackstone, which is a 10-year period that you're locked up, you can vote with your feet and move right away. They worry about ratings. Morningstar, are they a 5-star? Are they a 4-star? Are they a 3-star? So that performance, to perform right now, right then, is an added pressure. So on top of that, you would have that even if you didn't have activists. But the activists only exacerbate this issue because the activists, now 75% of the proposals that activists bring are short-term. So as opposed to, we have a proposal, we think that you're not spending enough money on R&D, you should be investing more in your business, you're paying too high a dividend. That's not a proposal we often see. What we see is you should sell the company. You should sell assets. You should spin something off. You should increase your payout. You should do stock buybacks. Those kinds of proposals, or changing the board, are 75%. I may have said that, but 75% of the kind of proposals you see. So when you see, it got a lot of attention, Bill Ackman on Valiant. He worked with Valiant to acquire an Allergen. And long battle, which he ultimately didn't win. What was his proposal? He said, I've seen what Valiant does. They should cut their research, like Valiant does, 90%. And so that's a big part. Now, I'm not saying that wasn't the greatest idea of all time. Maybe it was. Maybe it would have been better for the value of the stock. But that's the reality of what their suggestion, of what is the predominant kind of suggestion. And so what we've seen over the years is that, and what I, in my practice, saw is a more shareholder-centric model where the directors would have less discretion, be less insulated. Yep. I think Lucian would say, because if you insulate directors, you're just going to insulate underperformers, and they won't have the discipline of the market. So we don't want to insulate them. But what you've seen from, let's say, over the past 20 years is increasingly shareholders micromanaging, more of a, we need a town hall kind of approach to shareholder governance. So instead of your elected representatives doing it and then you'll check them out every couple of years, we want votes on pay, we want votes on changing the bylaws, we want votes, you can't adopt a pill. We the shareholders, want to control it. Now, what we see at Blackstone is the reaction of a lot of CEOs, I want to go private. I want to get out of this quarterly system. They also want to get out of the litigation risk that, they say one thing, they're going to be sued for misrepresentation. So that's an element too, but that's a different panel and a different session. But they hate what they call quarterly capitalism, that they have to run the company for what the earnings are going to be this quarter or they're going to be severely punished. They like having more run room. So what are... I think one thing we should also note, because it'll be relevant as we go through the discussion, and this is something that was coined by, which was already mentioned, the Chief Justice Leo Strine, that when you think of the stockholders has really changed over the years. Who are the stockholders? So when you look at a hedge fund manager and you compare it to what it was 50 years ago, where you had very strong retail ownership, and the people who voted the shares were those who directly owned it, you now have what he calls a separation of ownership from ownership, which is that you now have hedge fund managers who don't really own the stock. They get a percentage based on what happens with the stock. They're entrusted as a fiduciary, but they're not the ultimate owners of the stock, which are the people who invest in those hedge funds. And that divorce is also part of a big element of what's happening, because those retail investors used to be much more supportive of management in general, and they still are more supportive of management, retail, as opposed to institutions. So a few reactions to the solutions. Certainly, no doubt, you would make boards feel more comfortable. It'd be more like the Senate. You have someone that are politicians elected for a period of years, and they're not subject to the passions of the moment and give a chance to do something. I feel that would be very difficult to achieve, other than companies that are going public, and which was mentioned. In terms of companies going public, for most firms that are going to take, owners that are going to take a company public, if you're an entrepreneur, that may have some appeal, because the dual classes were suggested by companies that have sort of entrepreneur visions. So somebody like a Mark Zuckerberg says, I want to basically, even if I sell down my shares, I want to still have my vision controlling this company. And we can talk more about dual class. So that would be a possibility. For a firm like Blackstone, it's so unusual that vis-a-vis our fiduciary role for our beneficiaries, to complicate life with this may impair value. We don't know, and so people haven't used it, and that would be an issue. Another issue is, could you deal with the incentives of the hedge funds? That would mean the people who invest in them would say, I want more of a long-term focus. There could be, for public companies, long-term metrics. You don't really see these metrics advertised as much as EPS, but maybe those long-term metrics that relate to long-term performance could be more focused on. The hedge funds are, the disclosure really allows them to be quite the wolf, because it's very late to the game that they have to disclose their position. And even when they do, the way in which they own their position, that is, how much of it is hedged, how much of do they really have an economic interest, is not been well addressed. And so that could be fixed. And I think finally, there's a whole issue around this issue of who's really voting the shares. And one example would be that you have index funds. Well, how do index funds vote their shares? Well, index funds vote their shares the way that actively managed funds do at the institution for which the family through which they belong. And an index fund basically is going to hold the shares forever. So it's a real ultimate buy and hold. Whereas an actively managed fund may be more of a short term. So it makes no sense really for the buy and hold kind of index fund to be voting the shares the same way as the active. And maybe there could be a break in that, and that the the index funds would have to not simply follow the active management funds, but really follow a voting policy that was very disciplined and reflected that they are long-term investors. And it may be, maybe not, as we get more into it, this whole area of who votes the shares and how they're voted, given this divorce between ownership and ownership, as I talked about earlier, is also a very ripe area.
Okay, thanks a lot. David, what's your reaction to standard public companies and concerns about short-termism?
Thank you, first of all. And I'll try and pick up on a few themes here and be brief, and we can make it a discussion. I will add that I think far and away the most useful thing I've done in my entire career for corporate governance is to be Lucian's research assistant for his paper on staggered board and poison pills. But I'm of two minds of this. I think much the same way you hear. the rest of the panel. We run a business, a global roofing, waterproofing business. It's private, makes it a lot easier. I can't imagine what it would be like to have to run that business reporting quarterly, and I think about it a lot because most of our competitors are public companies, and it's almost fun to just watch them be tortured, having to answer these questions on a quarterly basis. And one of the things I would sort of highlight is, it was true 30 years ago in the takeover debate, and it's true now because, as you point out, the takeover debate has been, the activism debate is sort of the new takeover debate. But you really do have a difference, I think, today, which is, don't underestimate the rise of technology and the way in which technology is changing every industry. And then the anxiety that creates for executives, the need for executives to be able to, think, for the medium and long term and take strategies that may not pay off or may not be so obvious to the traditional shareholder, I think is more relevant than ever. And I think John correctly described, much of the misincentives you've had at the same time the rise of hedge funds, and their incentives are very misaligned in many ways. It's always easy to just beat up on the hedge funds, but it's really quite true that their incentives are misaligned, and so many of them have gone out and promised their LPs this sort of unicorn of low volatility, non-correlated equity-like returns. And the truth is, it's a very volatile world, and that doesn't exist, right? And so that makes you increasingly short-term. At the same time, we sit on the other side. We take positions in public companies where we're often, considered an activist. We just, had one this morning where we had a large stake in a Swiss chemical company that where the merger just broke up, and I find that this is a situation. This was the Clarence Huntsman situation where we own 20% of the stock. And we are long-term. We're private. We're long-term owners, and we're there with a message that you need to management and to other shareholders that you need to continue with your strategy. And without going into all the details, you need to continue with your strategy. What you're doing is off strategy. And as a matter of defense, there's this kind of defense in a box where they say you're a hedge fund. Well, we're not a hedge fund. They say you're thinking for the short term and you don't care about it. And it's the same arguments over and over again. And I think you need to try to define which are sort of activists proposing very short term proposals who don't really have an incentive to think for the long term. And who's being constructive and acting like an owner. And so, what's kind of a heuristic with which you could, distinguish one from the other? And I would sort of throw out this, and then I want to make one comment about Judge Jacobs' proposal, which is, I think it comes back to ownership and this concept of ownership, right? This whole problem started with the classic, agency cost issue of, hey, we separated ownership and management, right? And now people have misaligned incentives. And so many of these proposals are ultimately, to this idea, whether it's people wanting to go private because there are restructurings they can do, in the private, or founders wanting dual class structures to hold on, come back to this idea of having a real stake and a real ownership, and that's often a way we can distinguish what I would call helpful activism from unhelpful activism. Because I would say real owners tend not to have the incentive to do things that are not in the long-term interest. The other thing I would say is this idea of having a somewhat longer term horizon, but whether it's elections every 3 years or 5 years. I think this is actually a concept a lot of people could come to agreement on. It's interesting. I didn't even know before this panel Judge Jacobs' proposal We were just talking about it ahead of the panel, but there is a group called the Long-Term Stock Exchange. It was just written up in the New York Times. It's actually a friend of mine from college, my roommate from college, Eric Reese, who's doing it. I think to Lucian's horror, we've been supporting him in doing it. And the whole idea is in there before the SEC, and the whole idea is to create a new stock exchange that uses listing standards to allow people to think for the long term. And he comes out of the West Coast, out of this VC culture, and where people don't want to take their companies public. And so the idea is you align compensation, you act like an owner, you align compensation, and you have a longer term voting structure. And I think that's a concept a lot of people could get behind. So,
John, you spoke about public companies, standard public companies until now. Maybe you can comment also on alternative structures now. Either dual-class structures that Justice Jacob favored or private equity. How much would you like the world, and do you expect the world to move in the direction of structures where providers of public capital don't have the
I heard Dave I'll hit that. One thing that David said is that they're looking at ways in which companies wouldn't feel the need to go private, which obviously I don't want to go too much in that direction because it's great to have people wanting to go private. But the dual class, to me, is a great idea in terms of getting back to what was the original problem identified with this divorce between ownership and management, which is this disconnect, which is really maybe it's an exaggeration, the obsession of the cottage industry of governance, that you have this delinking between ownership and professional management, and maybe the options try to get at it, but that divorce is the big conflict. So what's going on with the dual class? The dual class is looking at a company, take like Facebook, which has a dual class. So Facebook, when Mark Zuckerberg wants to go public, says, I want the company to keep my vision even as I sell stock. And as I sell down stock and wouldn't have the same majority kind of control, I want one slice of that stock to have extra votes, super votes, and therefore I can continue to control the company. And to me, and by the way, even with the sell down, he's got 14.8% of the overall stock, even though he's got a majority of the votes. He's got 14.8% of the overall economic interest, which is $46 billion, which to me still creates a lot of alignment with the public stockholders, even though it's only 14.8%, because he's obviously very invested. And to me, that solves the problem of, gee, we've got this management that's disconnected, because right there you have the entrepreneur, owner, manager, who's very invested in the company, yes, sold down shares, but still has $46 billion worth of stock. Now you could say, gee, well, what happens when he dies or he sells off more stock? Well, there can be sunset provisions that address a change over time, but at least for a period of time, you can sort of keep that. So for me, I thought it was terrific. Of course, it's hated, dual class, by corporate governance types. They can't stand it. And after Snapchat, they made it clear, because they pressured S&P or other indexes, that you can't include dual class in your index. And if you can't include it in the index, people aren't going to want to do it. So I was very disappointed that there wasn't more of an embrace of the dual class.
David, you want to comment on dual class also?
I mean, so I'm a little more skeptical of dual class, but I agree. It is that you hear from these big Silicon Valley companies, right, that going public is like, this is their baby, right, and they've grown it since and going public, it's like having your baby hacked up into pieces, right, and it's crazy. Look at Facebook, for example. I mean, they botched the IPO. They were calling for Mark Zuckerberg to resign, right, the first quarter they were public. So there is that insanity to the public markets. I think dual class share structures the kind of the last solution I would get to, and I would tell you why, is they're so ripe for abuse. Sunset provisions are helpful. The other side of that is, which is another large public situation, is the Sika Saint-Gobain situation. So Sika is a large multi-billion Swiss chemical and building material company. Saint-Gobain is a huge French conglomerate. So you had what was effectively a dual-class voting structure. This dual-class voting structure was not owned by Mark Zuckerberg, founder, entrepreneur, genius. It was owned by a family that was no longer in management, kind of sleepy, and was increasingly at odds with management. And so what they did is the family essentially sold their super voting shares to a competitor for a huge price. So a competitor was able to come in and buy these super voting shares at an enormous inflated price and effectively try to raid the company that way. Now that's ended up in litigation. It's how it finally rests, we'll see. But that's kind of the abuse that these dual class things can be put to if they don't ultimately have sunset provisions. They can become zombie-like. It's one thing when you have the energy of a Zuckerberg. It's another thing when it's like the family's a few generations down and they don't know what they're doing.
I want to leave substantial room for audience questions as well as comments and expression of views. But let's have the panelists for a little bit longer. Jack, you wanted to offer some reaction?
Just two quick observations. First, I'm devastated to learn that this idea of an alternative stock exchange that would promote patient capital, which I thought was a brilliant idea on my part. It's already been thought of.
Pretty sure he took it from you if this was a 2010.
Secondly, and I think that this is going to become more apparent when we all engage in this discussion, is that one of the problems with the discourse about this topic is that for every proposition, for every opinion, there's a counter-opinion, and for every fact, there's a counterfact. That is, we can't agree on the facts. For example, my good friend John Finley spoke to us about McKinsey's study, that showed the misgivings of the corporate community about the short-termism, and I have no quarrel with that. But only last week, if you'll bear with me for a minute, there was an interesting Wall Street Journal article by Paul Singer, who is the CEO of Elliott Management, one of our larger activist investors. And he said that, there's nothing inherently contradictory about long-term versus short-term. You can have a short-term strategy that also creates long-term effects. And I don't have any quarrel with that. My quarrel, of course, is that it doesn't happen all the time. It may happen some of the time, and we've got to find a way to distinguish or to measure, to identify, the good times from the bad. But most importantly, Mr. Singer goes on and says, this conception of the contradiction or the antipathy between short-term and long-term has been, and I'm quoting, utterly demolished by none other than Professor Lucian Bebchuk, whose event studies, Mr. Singer says, found that activist interventions resulted in a 6% rise in stock prices on averages that the target companies managed to hold onto for over a 5-year period. So, part of our problem is we're not sure what the facts are, and I think that is a work in progress as well as just trying to conceptualize where we are and where we ought to be going.
Thanks. It seems like I would have to say something at some point. But first, we want to hear more from the people who came from far or medium far to enlighten us. John, you want maybe to say something about private equity and how it fits into this discussion?
Yeah, private. We are sort of our slogan at Blackstone is art of the long view, and that is really the essence of how we manage capital. As I mentioned, our drawdown funds, there is no redemption. It's 10 years that you're locked into the fund, and our compensation, unlike getting paid for increase of value on paper at the end of each year, we only realize gains or profits or from our investors. When we realize profits, we sell the asset and their gains. So there's really no incentive in any one quarter to be accomplishing something, because until it's sold, you don't realize anything. We do report quarterly to our investors, and those investors sometimes would say, gee, it doesn't look so great what's going on, but since they know they can't sell, and they're with us for good or bad, and mostly, fortunately, it's been good, it creates a whole different kind of dynamic and incentive and pressure. And so private equity has outperformed the S&P 500 over any lengthy period, whether it's 5 years, 10 years. In recent years, have been more on top of each other because the market has done so well, but over time. And the fundraising has never been better. The fundraising is really terrific, and institutional investors are allocating more capital, allocating more to private equity. And part of it is that they believe in our thesis of what we do to create value. And so how do we create value? I've mentioned that part of it is the long term, and part of it is the structural elements, but also part of it is what do we do when we get a hold of a company? And we, what we call it is operating intervention. And so when we take XYZ company, it may be that we put, well, the first thing is the leadership. Who's leading the company? And that's probably the most important decision, in making sure the leadership is good. And if the leadership isn't good, making changes in the leadership. But also group purchasing, leveraging healthcare, sustainability, operating improvements, operating leaner, IT support. The notion sort of, which is kind of old-fashioned, sort of the way it was maybe 30 years ago, the cliche that it's about job cuts, which is not true. I think the best studies show that it's net job increase, or just slashing and burning, when really a lot of the increase in values through growth, it's really through those ways, all of which require a really patient, long-term approach. Now, it is possible, and Dave made the point, some activists have a plan that is long-term. The Ackman plan with Canadian Pacific, and he brought in a new manager, and it was a longer period, and I thought it was a terrific plan and action. So we do have to avoid what I would call simplistic, kind of cartoonish boxing. Really, is it a good long-term plan or isn't it, based on what is showing up? But that is the way in which, at least from a private equity standpoint, it's long, it is patient capital, and very much a long view, and why it is.
David, you want to offer
and I assume the other thing you do is you make sure your leaders aren't, their compensation is aligned with the compensation of, yourself or your LPs, which I think is so much of the issue comes down
totally
to that
aligned.
is that if we're going to think for the longer term, one of the things I love about working with these, you can cite one of Lucian's papers for anything, and he had a paper, showing that CEO compensation was the only thing it was ever tied to was size of company. It didn't correlate with anything else. It's I think if we're going to expand the horizon on and be patient, then you have to be very fixated on management incentives and CEO compensation, and making sure that your leadership is compensated at the over the same time frame, and I think that drives a lot of it.
Just an aside, one of the big reasons that CEO comp went up so much was stock options. Now, stock options was the idea, gee, we don't want these managers divorced from the stockholders and just getting a salary and bonus. So let's just make sure it's really driven by stock options. Then they gave a lot of stock options, and with the markets the way they've been, what the Dow was 1,000 in 1980, and now it's 23,000. That whole ride on stock options has really fueled part of why CEOs' comp is so much of a higher multiple than it used to be of the average employee.